Hello, everyone. This is Dr. Friday today. I'm excited to guide you through the process of creating projected cash flow. Okay, let's get started. All right, first of all, you need a capital requirement. Okay, once you are investing in this projected company. Okay, remember that we are doing projected cash flow. So first of all, you put what you're investing in the company. Then the next thing is that you look at what income, where you are making income from. Okay, you can have several areas where you are getting income from. So type it. So as you click the income, you look at the income and see if there's any income you have not captured. So if there's anyone you have not captured, then you can also add it, right? So look at the salary. You also fill the salary. Okay, probably there is several salaries, personnel that you have in your company, okay, that you want to add. So you have opportunity to add them. Then the units, if it's 2 staff in logistics, you have opportunity to also add them. Then you also go to startup expenses. All these startup expenses, marketing, brand, equipment, insurance, licensing, you also itemize them. All right. It makes those assumptions. Right. This is not the only assumption you need to make. You could have several assumptions you are making because it's a projected cash flow. All right. So once we finish this, the next thing you do based on this, my projected cash flow, it's not that it's limited to what I'm presenting. It sure depends on how you want to design your assumptions. I also have additional assumptions. I call it projected income analysis. Okay. Remember that the first projected income for the first month that you are starting, the first month as you are planning your business and you are making projections. So that first month, you need to know what you are making for that first month. All right. So this second one now is link. You just say equals to use 3D references. Okay. Take it for the first month in first year. I'm making a projection for 5 years. All right. So now in this first year, assume that you are going to make income is going to be constant for this first year. Beginning from January to December, it's going to be constant. That is the assumption. So you now say equals to, click that, then you click and drag. Then you add it. All right. So you've done that. Then you can also I added percentage increase here. You can say, okay, in the second year, my sales will increase by 10%. Okay, I say by 10%. So it means that you now come, you say equals to, all right? This, you make this absolute reference, all right? Dollar sign in between them. Then times the sales for the first year. Remember, we are making projection for the second year. So if you do that and drag it, you see that the percentage will just stand still. Why? Because of the reference, absolute reference that we added. All right. So it could also be that the third year, your percentage, your income will increase by 120%. And you also come and do absolute reference, multiply it with this. So you drag it down. All right. All right. We are making projection for all our sales for 5 years. And it can also be that it increased by 30%. Okay. You lock it with dollar sign, apply by the third year to get the fourth year projection. Okay. Press enter. All right. Then it could also mean that you are increasing still by 30%, 130%. So whatever is your percentage you are projecting, fix it there. Right. So when you do that, you drag and click. All right, see, I've made projection for this projected income analysis. Now, if I say in the second year, my projection would have been 5%, for example. You see the impact now. See it? Or it will impact on the third year, fourth year, and fifth year. Right? So that is one way we can make projections. All right. So whatever you add here, because you are making projections, you say, okay, in the next year, I will make an increase of this. In the third year, I'll make an increase of this. But one thing you should do on income projection is that you should not expect more. Your projection should not be so large enough. Okay, because you are making projection, you try to ensure that your income is not too overstated. All right. So that means that this one that is 20% can be 10%. This one can be 12%. Okay. This one can be 15%. Right. Take the first month for wages, which is 42,000. Then you come and add cost to drag. Okay. Right. See it in the wages, we are making a projection of 42,000 every month. Can use just fill in this. Okay. Now I've made projection for the wages. And the next thing is investment. All the investment you have done in another companies. So first of all, we need to know how many companies we have invested in. Okay, so you can have it listed, the number of companies you have invested in. Okay, you have it listed on these sheets. All right, so, and the sector. Okay, have it listed, then you come and add up. All right, so that's done. So we're able to know the company we want to invest on. So we have it listed out. Okay, so that as we invest every month we are investing, we are capturing it. We are capturing it. Okay, then you now link it to this chart. All right. So what I've done now is just say here equals to this, and drag it down. We'll drag it down. Right. So anything you put here now, we have in this company now, we have 7,000 naira invested in this company in July. You see that it will reflect on this July here. Okay. So once you've done that, you now come to the cash flow. Remember, we have income note 2 and note 5. Okay, and note 2 and note 5 is this note 2 and this note 5. This note 5. So we'll not link into cash flow. Remember, in a projection, the first month, you are not expected to make money. You are not expected to make sales. So you will not need to recognize sales. So you will start from the second month, which is February. Click equals to and go. So you will not start from this first month. Start from this February. Okay. Then you click and drag. There you come it together. Right? You can drag this down. Now the next thing you take now is capital requirement, which is on note 1. Click equals to this. Right. So you are done with year one, all the inflows, all the cash receipts. You receive this capital invested, you receive this cash income you have received for the year. All right. So the next thing you do, remember this part where it's colored blue is you don't need to type on it. Okay, it's linked. You don't need to type on it. All right. So now we need to take the startup expenses. You click here, say equals to from the assumption. Okay, this is startup expenses. Pick it. Right. Then you need to pick wages in the note 3. We have it projected from January to this. So you can also pick, you can just pick that this one, these wages, projected wages and salary. Click it, then you drag it. Okay. Now you have it summed. Then every other expenses here, the rent, whatever you put there. Okay, at least you're expected to pay rent, and you're going to pay it 1st January because the first month before you started the business. Okay, then all these expenses now, all these expenses, it's possible that you are not running these expenses in the first month because these expenses I have here, they're already embedded on the startup expenses. So you can come here and add 5,000, 6,000, and roll it down. Then you come and it equals to. Okay. Then if you drag it down like this, remember you're making projection. It means that if I change this one to 8,000, the first one will change. If I change this one to 3,000, this one will change. Okay. Then while rent will just be paying the first month, right? Taxations, interest, all this one will not be paying yet. Okay. You may not have known the taxation. You could also have known the taxation, but I want to link it to the profit and loss account. So when we get to the profit and loss account, we will link it down. Okay. Then cost of sales, 10% of income. So it can be that the cost of sales, which is 10%, click times 10%, right? Then you click and drag. Okay, that's the cost of sales. Okay, the next thing is so all cash receipts. All cash receipts, take this. Then all cash payments, you draw it. You take either shorted this minus this. To have shorted. Being the first year, there is no opening balance. So it should have been the sum of this plus this. So you drag it down. Then you take beginning balance from the previous months. All right. So you've done for the first year. Okay. The next one is the third year, the second year. Okay. Second year, just link the first year cash flow to the second year. If you are doing up to 5 years, but in this case, I'm doing up to 5 years. Okay, so just link it, and have it shown. Then here we already have cash income. Cash income is already on the second sheet. Okay. Right. No capital requirement. Only have a capital requirement in the first year. In the second year, the wages will be this. Right. So this will be one first year, not 0 year. This should be second year. This should be third year. This should be fourth year. Then this should be fifth year. Okay, you've done that. So you can come and take this. Is for demonstration. Take this. All right. Told you anywhere we have blue color, you don't need to type it. Okay, formatted already. Right. So here now we have cost of sales 0.1, 10%, and it's this. If 10% is what you are using, remember it's a projection, can be more than that. Then this take the way we did the first one, right? Take the cash payments, right? Then you take this plus this, right? Then this opening balance now come. This become the opening balance for this, right? This beginning balance for the next month, right? So done for second year. Third year, you also do the third year. Right. Then the third year, you take the income, get the income for the third year. All right. Then you take the projected wages for the third year. Right. In cash flow projection, it's good to have it 3 to 5 years so that based on that you can be able to know when you actually break even. Okay. Told you where we have color, you don't type on it, or where you don't have color, you can change the figures. Okay, that's exactly what I'm doing. Right. This, this, take this, right? Take this, minus this. Okay. Right. Then the opening balance for the third year is the closing balance for the second year. Right. So, all right. That's for the third year. And then the fourth years, we also come take, since all the information in year one will be repeated in all through the years. That's why I'm making it. In the year 4, income projection is this. Take it right. Then in the that's a year 4, the wages projection is this. Okay. Then you can come and add any figure you think is appropriate based on your projection. Okay. All right. Then 10% of income. Right. And this last year, which is the fifth year, that's where I am. Right. The income now, the projected income is this. So you click and drag. Right. Then the projected wages is this. Click and drag. Right. You are going somewhere. Right. Right. Okay. I'm going. Right. So you take the beginning balance of the second month is the first month. So you do that. So you can see that we projected for cash flow for 5 years. 5 years. Okay. 5 good years. Projected for cash flow for 5 good years. Not adding investments. Let's add investment for the first year. Okay. That investment is year one. This year two. This year three. This year four. This year five. Okay. Then the next is that if you have interest you are paying at the end of the month, maybe you are paying interest of 50,000. Add it there, right? Then this one, interest of 6,000. Add it there, right? Then investment for the second year. Add it. Second year, you also did investments. Add it. Let's take it from note 7. Okay. This cost of sales, we add this one. Let's then drag it. Add investment for the third years. Drag it. Right. Then you can also add interest. Okay. We'll get to tax later. Interest is coming last because at the end of the year will be when you are paying that interest. Then the investment for the fourth year, is this. Let's add. Then the cost of sales. Okay, let's take the investment for the 50 years. This is the investment for the 50 years. We also drag the cost of sales. Okay, times this. You also drag it. Then you can add 100,000 as your cost of sales as your interest. Right. So we have projected for cash flow for 5 years. Let's look at if we have captured fixed assets. The first year there was a fixed asset. The second year, second year there was fixed assets, 100,000. Third years, there's fixed asset of 200,000. Okay, let's end it there. Okay, or the last year there is a fixed asset of 250,000. All right. Okay. So the next thing we need to do is to check the profit loss account. Remember, we have it in 5 years. This one is already here. This go to the cash flow and pick the income. Of course, this is the cost of sales. This is the cost of sales. You pick the cost of sales. Okay. This is the startup expenses. We start it from here. This place, this startup expenses. Then you drag it to rents. Okay. If you come to cash flow, you see that there is a rent, there's tax, there's interest. So it will get to tax and interest because that will come after the total expenses, after the gross profit and net profits before tax and interest. Okay. So you can even just come and pick this as interest and a tax. Okay. 30%. So to get this, you need to use some if. Some if. Take this. And you take the criteria. And you take the rights. Right? Then for the income, take some if as well. And income is here. So you can take it from here. The cost of sales is there. Take it from there, comma. Then this. Right. So this minus this can give you this. Okay. Then you come and take this. Okay, you can just take this now because it's of the same size. It will just give you this one. Then I'll come and put $sign to lock it. $sign to lock it. That will enable me to drag it now. Beautiful. Then I come and put interest. Interest. Beautiful. Then tax. Times 30%. Beautiful. So this tax now, this tax will be linked to the cash flow. That's the tax I'm expected to pay. Beautiful. Then the dividend if you have, and the retain, same this minus the dividends. Okay, brother, if you have anyone, it will be sum, right? So we take it from year one, take equals to cash flow year one, cash balance year one. Okay. Then, of course, we know that net current assets is this plus this. So you take and drag it. Okay, so then the PPE and investment is this plus this, drag it. Of course, this plus this is what give you the net assets. Okay, then equity. The equity is can take it from the first cash flow, the money that was invested, then net profits, and take it from first year. Right, so you can see that you have a difference of 166,000, 116,000. Okay, so let's take the investment for the first year. Is the investment for 6,000. Okay, we are coming to 80,000 now. That 80,000 is the fixed asset, but there's a depreciation. So you go to fixed asset schedule. Now, I already arranged the fixed asset schedule. Addition, balance at end of the first year. So the addition now is taken from cash flow, which is this. It's sum of. Right. Now, the net book value for the beginning of the year would be beginning is this, nothing. The net book value for the closing of the year is and this. F16. So this will be transferred to balance sheet. Let's take this to balance sheets. You have a different this sum up. Okay, sum up because we have has captured the depreciation. Depreciation 16,000 from this. So you can see the balance sheet is accurate. Okay, the next thing now is the second year. Okay, so you can take the equity finance since it's constant. Then you can take the retained profits since it's constant. The second year to the fifth year. All right, you can see the differences we are seeing then. Then the balance, cash balance, take for the second year. Okay, I'm taking for the first year already. Take for the second year. Take for the third year. Take for the third year. Take for the fourth year. Then you take for the fifth year. All the balances for cash book. All right, so you can see the difference here. Now, the next one is the investment you have invested in other companies. Take for the second year. This, and you will add the previous year balance. Okay, then check for the third year, investment for the third year. Then you add the second year balance. Check for the fourth year. And you take the balance third year. You take the fifth year balance on the cash book. Then you take the balance, total balance of the fourth year. All right, so we can see the differences now. Now let's fill in the PPE. PPE. All right. PPE, you have this balance here, coming here. Okay. Then if the addition, you have the addition on the cash book, the second year. This addition here. Okay, when you add it together, you have total. Then this depreciation is the depreciation for the last year, the first year. Okay, to come in there, right? Then the depreciation for the year is 20% of the 100,000. And of course, when you add it together, you have the total depreciation, related depreciation. Now, this will now be this first beginning minus the beginning of the depreciation. And this one will now be the closing balance and the closing balance of the depreciation. So this amount, 128,000, will be transferred to the balance sheets. Okay, you can see that you have a balance figure now. This and this balances. Then we'll go to the next one, which is the third year. Okay, third year now. You come here, the beginning balance for this one is this. The beginning balance is this. Okay, if there's any addition, add it. Third year. Then the beginning balance for this one is this. If there's any addition for depreciation, add it. Let's check the cash flow, whether there's any. For the third year, there is 200,000 fixed assets. So you link it here for the addition. 200,000. Beautiful. So we have total MPV. MPV. Now you take a depreciation of that. Take a depreciation of that. Take 20%. It's the 200,000. So you have a total depreciation. So now the beginning will now be this minus this. The closing, this minus this. So this amount now will be sent to, say, balance sheet. Okay, let's send it to balance sheet. See what we have. This amount. So we have a balance. So this could be the depreciation. Let's see. This amount is going to depreciation. All right. So you come here, type this amount to depreciation. So let's check our balance sheet again. Balance. Okay. Then the fourth year, you also look at the cash flow, whether there's assets, there's no assets. Okay. Whether there's assets for the fifth year, there's assets, which is the last year. So for the fourth year, since there's no assets, we will repeat this. This will come here. This will come in. Okay. Have all of this. It's no addition. Have all of this. Right? So the closing will now be this. The beginning will now be this. Closing will now be this, which is the same. So this amount will go to balance sheet, which is this. Still have 76,000, which will go to profit and loss account. Okay. A progressing, which is this. All right, check the balance sheet balances. Then you check the last year, there is a fixed asset purchased. So you come and pick that fixed asset that is purchased last year, 250,000. Then you come pick this, which is the closing balance. Then you take the sum. Beautiful. Take this. Take the 20% of 250,000. Take this. Beautiful. So beginning balance will now be this plus this. And the closing balance will be this minus this. All right, this 300,000 will be transferred to balance sheets. Have a different 120. So this 126,000 transferred to profit and loss account. So check your balance sheet balances. So with this, you see that you have been able to project for your cash flow. So you can see the visualization. It's a graph. Okay, see the graph for decision making. Okay, so now you have your balance sheet balances. Now, if you come and you can see that we are making loss. If you come in the absorption, you increase any of the income. Okay, you say this income I was expected to make 100,000, and I was expected to make 200,000. See your balance sheets. See it having a positive. If you find this content helpful and believe it will benefit others, please subscribe to my channel, share this video, and leave a comment below. Your support helped me provide more valuable insights on projected cash flow. Thank you for taking the time to watch. Look forward to see you in the next video, where I will explore even more strategies to enhance your financial management. Thank you.